Silver hit $80 per ounce on December 28, 2025, capping a 158% surge in just 1 year. But in the first 4 trading days of December, 47.6 million ounces disappeared from COMEX registered vaults, over 60% of available inventory claimed for physical delivery. Prices doubled, yet industrial buyers still drained the system. This isn't a peak, it's a fracture. Registered stocks dropped from 113 million ounces in late November to under 65 million, leaving less than 90 days of coverage for the electronics sector's 465.6 million ounces of annual consumption. Backwardation gripped the market, with spot prices commanding premiums over futures, signaling immediate physical scarcity that futures can't promise. Lease rates spiked to 200% annualized, a cost no manufacturer budgets for unless supply channels are breaking right now. And JP Morgan, holding an estimated 675 million ounces, reclassified 134 million from registered to eligible status exactly as the drain accelerated, pulling supply off the table when demand hit critical. This is the system losing grip in real time. I see this unfolding not as isolated market noise, but as the culmination of 5 consecutive years of supply deficits, totaling around 800 million ounces since 2021. That's nearly a full year's global mine production, 843 million ounces in 2024, erased from stockpiles without replacement. Recycling added just 180 million ounces last year, far short of closing the gap. The 2025 deficit alone runs between 117 and 206 million ounces, depending on how aggressively you factor in accelerating industrial pull. Electronics aren't optional, they're the backbone, consuming 465.6 million ounces annually in conductive pastes, solder joints, and electrical contacts that no substitute matches for conductivity, thermal stability, and reliability at microscopic scales. Solar panels alone took 230 million ounces in 2025, up from prior records as renewable installations ramp. And now, emerging tech like Samsung's silver carbon anode solid-state batteries could layer on massive new demand, 1 kilogram per EV pack, or 32.15 troy ounces, versus the current 25 to 50 grams. If even 20% of global EV production shifts, that's an extra 514 million ounces annually slamming into a market already short. But let's trace this back through the signals that should have screamed warning earlier. DRAM prices didn't creep up. They exploded 60% from September to December 2025. Taiwan's Transcend information alerted customers that manufacturing costs doubled in a single week after Samsung and Western Digital failed NAND chip deliveries for over a month. That's not market adjustment, it's cascade failure. Every memory chip, circuit board, and high-frequency device relies on silver in bonding wires, lead frames, and conductive adhesives that withstand 150 degrees Celsius operations without degrading. Copper oxidizes too readily, gold's too costly, polymers lack the endurance. Manufacturers tested alternatives for decades, but core applications stick with silver because physics demands it. Samsung's memory division posted a 62% operating profit collapse in Q1 2025. Their $37 billion Texas fab delayed to 2026. Subsidies slashed from $6.4 billion to $4.7 billion under component shortages. Official line, market challenges. Reality, the silver feeding those lines vanished into competing claims. This ties directly to China's quiet dominance. Shanghai Futures Exchange inventories sank below 446 tons in October 2025, the lowest since 2016, amid record electronics output. China holds 70% of global silver refining capacity, enforcing 99.99% purity versus COMEX's 99.9%. That gap creates a one-way flow. Western silver upgrades and enters China, but Chinese refined metal needs reprocessing to return, effectively locking it away. Spot prices in China hit record premiums by December 25th, backwardation reaching $3,000 per contract, buyers paying $3 more per ounce for now over later. Domestic shortages surfaced, even in the refining powerhouse, forcing manufacturers to bid urgently or halt lines. This isn't speculation. It's factories calculating downtime costs against premium payments. And while Western media fixated on chip fabs and Taiwan risks, Chinese buyers arbitrage purity differences, pulling metal eastward since deficits began stacking. If you've tracked commodity flows or work in supply chain logistics, how does this eastward shift look from your vantage? Share your observations in the comments. Does it align with what you're seeing in real-time procurement? Now, contrast this with historical precedents where systems held. In 1980, silver spiked to $49.95 per ounce, $185 inflation adjusted, on Hunt Brothers Futures Corner. Exchanges hiked margins, forced liquidation. prices cratered to $10 within months. Speculation popped because it was paper-driven, detachable from physical need. Here, industrial demand is inelastic. Samsung can't liquidate their solder requirements. Solar firms can't ditch photovoltaic pastes. You can't margin call a production line. The Hunt episode worked because rules bent to preserve the system. Today, bending rules exposes the fracture. Backwardation isn't fleeting. It's chronic, eroding trust in futures as delivery mechanisms. January 2026, historically a minor delivery month, shows record open interest amid persistent backwardation. If COMEX can't source metal from eligible stocks, vault owners like JP Morgan withholding consent, the exchange faces cash settlements that shatter credibility, or prices rocket to draw supply. JP Morgan's move underscores institutional foresight, accumulating 675 million ounces from 2011 to 2024. They controlled perhaps 40% of COMEX pre-drain. Reclassifying 134 million ounces to eligible removes it from delivery pools precisely when 47.6 million ounces flew out in 4 days. Not selling into the rally? That's betting on deeper scarcity, not a pullback. They see the math. Cumulative 800 million ounce deficit, flat mining, despite prices tripling from $23 to $25 in prior years. Why no response? 72 to 80% of silver is byproduct from copper, lead, zinc operations. Economics hinge on base metals, not silver windfalls. Copper prices haven't spurred expansions. New mines take 5 to 8 years from discovery. Primary silver mines, just 20 to 28% of supply, face the same lag. Even at $80, output won't surge till 2030 to 2033. This inelasticity mirrors oil crises of the 1970s, where shortages forced substitutions. EVs emerged from high oil, but silver defies that. Copper wiring swapped aluminum in spots. Rare earths prompted magnet redesigns. Electronics? No viable swap at scale without retooling every fab, board, process. Decades away, economically ruinous. Thin margins in semis amplify this. A $10 to $20 billion fab demands constant run. Disruptions torch profits instantly. Samsung isn't just missing sales, they're idling capacity while servicing debt. Western Digital, Micron, SK Hynix face identical binds. IDC warns memory shortages into 2027, not fab constraints, but raw material evaporation. Geopolitics amplifies the break. U.S. CHIPS Act poured $52 billion into domestic semis, ignoring silver's strategic role in defense electronics, aerospace, weapons. No allocation addressed supply. Focus stayed on Taiwan vulnerability, fabs. Meanwhile, China's refining edge drains Western vaults, securing their 5G, AI, EV dominance. This isn't conspiracy, it's observed flow. Shanghai lows amid output highs, purity valves sucking metal in. National security? Silver's embedded in comms, guidance systems. Scarcity could halt production as readily as chip embargoes. For those in defense or aerospace sectors, how are silver constraints manifesting in your procurement cycles? If you're noticing delays or premiums, detail them in the comments. It could clarify where the pressure points are emerging. Layer in logistics, just-in-time chains, zero buffers, assume endless commodity flow. Samsung doesn't hoard silver solder. Apple warehouses no excess components. Tesla maintains no reserves. Inventory costs kill margins. But when vaults empty 60% in days, lease rates at 200% signal borrowings untenable. Disruptions cascade. Samsung halts chips, downstream assembly stops, shelves empty. Digital economy grinds, revealing dependency on one unsubstitutable metal. History as mirror. 2008 financial crisis exposed derivatives detached from assets. Here, paper silver diverges from physical. Back then, bailouts papered cracks. Now, no central bank prints atoms. Geology rules. Mines can't accelerate byproduct output. Recycling? At capacity, sub 100% recovery. Automotive silver locks in for 10 to 15 years. Loss is inevitable. The acceleration proves control loss. Silver from $59 to $80 in Christmas week. 35% in thinned holiday trading, defying low-vol norms. Not discovery. Short squeeze in physical. Industrials bidding regardless. Analysts like Andrew Maguire eye $100 by 2026 end as suppression fails. December suggests faster. If registered near zero, prices to 150 to 200 to 300 to balance, or demand destruction. But industrials past costs keep running. EV pivot intensifies. 14 million units, 2024. used 11 to 22 million ounces at 25 to 50 grams each. Samsung's 1 kilogram design, 20% adoption adds 514 million ounces, 60% of mine supply. Permanent lock-in, no quick recycle. Solar's 230 million ounces grows 15% through 2030. Electronics swell with AI centers. Thousands of servers, silver per board. IoT proliferation understated in 465.6 million ounce figures. If you're involved in renewables or EV manufacturing, what's your read on silver's role in scaling? Comment with your projections or challenges. It might reveal if this demand spike is as inevitable as the data suggests. This nonlinear unraveling started with symptoms. Price surges, vault drains, before exposing causes. Byproduct constraints, Chinese arbitrage, unsubstitutable demand. But consequences loop back. January's open interest test delivery. Failures trigger stockpiling, removing more ounces permanently. Manufacturers shift from futures faith to private hoards, tightening further. Bank kill switches. Overnight rule tweaks, like 1980 margins, failed here. Industrials don't fold. They need metal. COMEX reclassifications, lease spikes, attempts to control. But physics overrides. System stability presumed endless supply. Now, depletion forces repricing. In finance or trading, how do you interpret JP Morgan's reclassification amid the drain? If it strikes you as positioning versus routine, explain in the comments. Your take could highlight overlooked institutional signals. Broader weave. Military sphere depends on silver for reliability. High-freak devices. No room for substitutes. Geopolitical risks. Taiwan's chips dominate talk, but silver's global, yet Western vulnerable. Logistics chains. Optimize for efficiency. Shatter on scarcity. History's 1970s oil embargo forced redesign. Silver's crisis demands similar, but timelines mismatch. Redesigns take years. Shortages hit now. The phase we're in. Discovery of disconnect. Paper markets promise delivery. Physical says no. Prices at $80 mark recognition start, not end. Deficits compound. New supply lags. Industrials compete, driving vertical moves. For economists or historians, where does this silver dynamic parallel past commodity fractures? Share comparisons in the comments, especially if you see differences in resolution paths. Final signals. Texas fab delay exemplifies. $37 billion investment, but idle without silver. Profit collapses cascade. Shortages to 2027 lock in pain. No resolution till 2030 supply. Meantime, repricing reshapes. This is the system at inflection. Control eroding, not through crash, but inexorable depletion. The drain continues. Backwardation deepens. Bids escalate. We've entered the era where silver's scarcity dictates industrial reality, and the adjustments won't be gentle. If you've modeled supply, demand, and commodities, what's your forecast for silver's trajectory given these deficits? Post your analysis in the comments. It adds to mapping this unfolding break. On December 29, 2025, silver retreated sharply to around $75 to $76 per ounce after touching an intraday high above $83 to $84 earlier in the session. A volatile 6 to 8% drop in hours. Spot prices had climbed past $80 the day before, capping a year where the metal surged roughly 160 to 181% from January levels near $29. Yet the retreat came amid profit-taking, not relief in fundamentals. COMEX total warehouse stocks hovered near 451 million ounces as of December 24th, but registered, deliverable, inventory remains critically low after the early December drain erased over 60% in 4 days. Backwardation persists in both Western and Shanghai markets, with Chinese spot premiums reportedly exceeding $8 over London, the widest on record. Lease rates, while not publicly quoted at the extreme 200% peaks of acute tightness earlier in the year, have stayed elevated through late 2025, reflecting ongoing borrowing stress for anyone needing immediate physical metal. This isn't correction, it's the market breathing after the first real confrontation between paper promises and physical limits. The December vault claims, 47.6 million ounces gone in days, forced recognition that futures open interest can no longer be satisfied without drawing down eligible stocks held by institutions unwilling to release at current levels. JP Morgan's earlier reclassification of 134 million ounces to eligible status looks even more deliberate now. They positioned to withhold supply precisely as industrial urgency peaked. The system didn't break overnight. It cracked under sustained pressure that built across 5 deficit years, now totaling around 800 million ounces, vanished from global inventories. Samsung's memory division offers the clearest downstream echo. While official Q1 2025 reports showed heavy pressure, profits down sharply amid component constraints. The narrative has flipped by year-end. Surging AI-driven demand for high-bandwidth memory, HBM, has pushed DRAM and NAND prices higher, lifting gross margins for Samsung, SK Hynix, and even Micron to levels that threaten to surpass foundry giant TSMC in Q4 2025. Yet this profitability masks fragility. The same silver-dependent bonding, soldering, and conductive layers remain irreplaceable in high-reliability chips. Manufacturers pivoted capacity toward premium AI memory, rationing commodity DRAM, and accepting higher input costs, including silver, at scale. IDC projections still point to memory shortages persisting into 2027, not because fabs lack silicon, but because raw material flows and strategic reallocations create bottlenecks no amount of capex resolves quickly. Chinese arbitrage accelerated the transfer. Shanghai inventories stayed depressed, yet domestic production roared on. Refiners with 70% global capacity pulling Western metal via the purity differential, locking it into their supply chains. Spot premiums in Shanghai hit extremes. Backwardation deepened to levels where immediate delivery costs far more than futures promised. Industrial buyers there calculated factory downtime as more expensive than paying record markups. Western manufacturers, still leaning on just-in-time and COMEX futures, discovered the disconnect too late. Elon Musk's late December warning that record silver prices could hit manufacturers hard landed as the metal briefly crossed $80, underscoring how EVs, solar, and electronics all embed silver without viable substitutes at volume. The volatility on December 29th, peak above $83, close near $75, reveals thin holiday liquidity amplifying moves, but the underlying math stays unchanged. Annual deficits project 117 to 206 million ounces short in 2025 alone. Mine supply flat at approximately 843 million ounces because byproduct economics dominate. Solar demand at 230 million ounces grows. Electronics at 465 million, understated as AI data centers proliferate. Emerging solid-state battery designs from Samsung could add hundreds of millions more ounces if scaled. Supply response? 5 to 8 years minimum for meaningful new primary mines, even at these prices. If you track memory pricing or semiconductor supply chains, how has the silver input cost shifted your margin expectations for 2026? Drop your read in the comments. Real-world procurement data often surfaces the pressure before headlines do. January 2026, delivery looms with record open interest for a historically minor month. Backwardation signals distrust. Buyers value metal in hand over contracts promising later delivery. If eligible vaults stay locked, owners like major banks holding firm. COMEX faces forced cash settlement, eroding futures credibility, or prices must climb until marginal supply emerges. Either path accelerates the shift. Manufacturers move to private stockpiling, removing more ounces from open markets permanently. This phase marks control loss in slow motion. No central bank prints physical silver. No policy conjures mines faster than geology allows. The 1980 hunt spike collapsed under rule changes because it was speculative. Today's demand is embedded. Solar paste won't vanish at $100 per ounce. Chip bonding wires won't switch materials overnight. Prices at $75 to $80 after the pullback aren't the floor. They're the new baseline from which further discovery begins. Backwardation, lease stress, vault depletion, all confirm the fracture widens. For those modeling commodity cycles, does the persistent backwardation in open interest spike signal a structural regime shift? Or do you see resolution through demand destruction? Share your framework in the comments. Contrasting views sharpen where the break might propagate next. Geopolitics overlays the fracture. U.S. subsidies built fabs, but ignored silver's strategic role in defense-grade electronics. China's refining dominance funnels metal eastward, securing their industrial edge while Western chains scramble. National security conversations fixated on Taiwan silicon. Silver scarcity could halt production lines just as effectively. The retreat today changes nothing fundamental. Deficits compound, demand accelerates, supply lags by years. Samsung's pivot to profitable AI memory shows industrials adapting, passing costs, prioritizing high-margin lines. But adaptation isn't resolution. It buys time until the next constraint hits. If you're in EV or solar supply planning, how are silver allocations factoring into your 2026 to 2027 ramps? Comment with your constraints or hedging moves. It maps the real transmission from metal to finished goods. We watch the system recalibrate, not through crash, but repricing. $80 wasn't the ceiling. The December drain wasn't the end. It's the mechanism exposing what paper obscured. Industrial necessity meeting geological limits. The volatility on the 29th is noise. The trajectory is signal. Control slips further each day, stockpiles shrink, and bids persist. For institutional watchers, what does JP Morgan's vault strategy imply now that prices have tested 83 plus? If it reads as long-term positioning to you, lay out why in the comments. Those moves often telegraph the phase ahead. The process unfolds. Depletion drives urgency. Urgency drives premiums. Premiums force behavioral shifts. No kill switch flips this back. The silver market has entered territory where physical reality dictates terms, and the adjustment phase has only begun. December 29th, 2025. Silver pulls back from the 83 plus session high to close near 75.50, an 8% intraday swing that looks like profit taking in thin holiday volume. But zoom out. The metal still sits 158% higher year to date, and the fundamentals that drove the December explosion have not blinked. Registered COMEX inventory remains below 65 million ounces after the 47.6 million ounce claim in the first 4 trading days of the month. That single event removed more deliverable metal than many entire years of net supply addition. Backwardation holds firm. Spot continues to command a premium over near-term futures. Lease rates stay punitive, and open interest for January, normally a quiet delivery month, sits at multi-year extremes. The market is not correcting. It is pausing before the next leg. The real fracture lies in what this volatility exposes. Industrial buyers did not pause when silver crossed $80. They accelerated. The same entities that drained vaults at record pace are still calculating the same equation. Downtime costs billions more than paying premiums for immediate physical delivery. Samsung's pivot toward high bandwidth memory for AI has kept their margins from collapsing entirely. But the silver solder, conductive epoxy, and bonding wires feeding those premium lines remain the same bottleneck. Every wafer starts with silver-dependent processes that no redesign has displaced at scale. Micron and SK Hynix show identical patterns, rationing commodity DRAM, prioritizing AI allocations, passing input cost inflation downstream. IDC's forecast of shortages stretching into 2027 now reads less like caution and more like baseline expectation. China's side of the ledger tells the same story with different numbers. Shanghai spot premiums reportedly widened to $8 plus over London FIX, the largest spread ever recorded, while domestic inventories stay suppressed. Refiners continue to pull Western-grade metal through the purity arbitrage valve, converting it into supply that never flows back. This is not opportunistic trading. It is strategic hoarding by the world's manufacturing core during a period when global electronics output hits records. Western manufacturers, still tethered to just-in-time and COMEX delivery promises, are left bidding against that machine. January 2026 delivery stands as the next stress test. Record open interest in a minor month, combined with eligible vaults partially locked by major holders, means any shortfall forces a binary outcome. Cash settlement that torches futures credibility, or prices that rise until marginal ounces surface from private storage. Either way, the behavioral shift accelerates. More manufacturers will conclude that futures are no longer reliable conduits for physical metal. They will begin building private buffers, ounces removed from open markets forever, tightening the noose further. This is not 1980 redux. The hunt corner collapsed because speculation could be margined out. Industrial demand cannot. Solar paste at $100 per ounce does not disappear. Chip bonding at $150 does not switch to copper overnight. The repricing we are witnessing, from $29 to $75 to $83 in 12 months, is merely the opening act of a supply regime that no longer responds to price signals on any relevant timescale. If you're modeling silver forward curves or industrial procurement right now, what probability do you assign to sustained backwardation through the first quarter of 2026? Post your numbers and reasoning in the comments. Those assumptions are starting to dictate real capital allocation. The system has not collapsed. It has begun to reprice reality, and the next move will not be quiet.